Are live. Good morning to everybody who's joining us online, and we're live. Thank you very much for joining us, and welcome to Behind the Markets. It is the Wednesday edition, what we like to term Wealth Wednesday. Today, we'll be talking a lot about risk. Managing risk, what is risk, defining it specifically for you who's entering an investment journey. One of the things that's specifically not talked about a lot is risk. Everybody just has fear, but they don't know risk. Understanding, calculating, and dealing with risk is often a way to help you navigate it, and you actually invest without fear. It doesn't mean you invest foolishly, you invest without fear. There's a difference. There's a difference between being fearless and being foolish. So today we are going to talk about that, but we're going to get into a few stories in the market and some market data. But always remember, tag your friends who you feel should be in on this today. Always give us a comment of where you are, who you are, and where you are joining us from, and we will get in contact with our studio on our radio audience as soon as they are plugged in today. So let's get down to business and let's get started today. So welcome to Wealth Wednesday. It is Munyo Mutwala. This handsome fella is going to be taking you through what we are doing today. So we did see the Kwacha touch on to 21.07 yesterday on the interbank rate. This puts a lot more pressure on our imported inflation and also on our energy-based inflation. So remember, this is where a lot of the unfortunate pressure is going to keep coming from. Simultaneously, we did see that the stock market yesterday closed at 9,153.83. That's due to Zambeef and CEC. CEC has continued. It's continued its run again, where it was up another percent. So up yesterday as well. Stock market up 0.1% yesterday, up 5.13% on the week, and 7% on the month, and up 24.75%. We did see the bond market up the day before 0.16%, but down in dollars about 0.27%. And interest rates have started to come down as of today. Now, we did also, we have also seen, now we did see that the Rand has moved down, as the Rand moved down a little bit in value as of yesterday. It was down about 0.42%, also on a day when the dollar moved. So you can actually see that's a result of the South African Rand intrinsically getting weaker. The South African Rand, unfortunately, was intrinsically getting weaker from yesterday. The South African Rand was intrinsically getting weaker. So that's also then at least keeping some of our imports down for the moment. Our import costs are potentially down, but there's still a lot of volatility. As you can see, the Rand is up 9% on the month, up 3% on the week, but down 4% on the day. So that's one of the key problems I think we're still facing, is the volatility between the Kwacha and the Rand. Now that affects a lot of cross-border trade. So everyone has to kind of just keep an eye on what is actually happening when it comes to the Rand Kwacha trade. Now, continuing as well, we did actually see that the GRZ bond index, as of the 11th of September, remember we tracked it a day earlier. We did see the GRZ bond index trading 0.16% upwards, but also 19% year to date. So we are seeing at least a slightly positive bond index, up about 10% above inflation. While we're also seeing that in terms of GRZ bond index in dollars, this is for the Zambians living abroad and also for the offshore investors, only up about 2% year to date, while interest rates are still up 0.98% year to date. Commodities, we did see copper slide back downwards, about down by 0.32%, while oil is up to 92. In fact, it touched as high as 93. And these are signals that are being sent now, thanks to the OPEC report and the positive and the optimism that is still being exhibited in the OPEC report. And then we also did see gold down about 0.6% as of yesterday. Now, here's where I am saying that we are potentially seeing a pump price that is probably up another 10% this next month, 32.4. So I'm giving you preemptive warnings. Now, one of the reasons I do this, by the way, is to help you potentially see where the risks are coming ahead. Okay, and it helps you plan as much as you can. So this is why you want to try and look at as much forecasting data so that you can prepare for what could potentially be on the way. As I've said to you, 32.4 kwacha. This is what we see the pump price being by next month. So we are probably seeing that, and there's very little that the powers that be can do about it. We're really looking at global forces, but right now, other factor that's playing in is also the exchange rate, down 6.19%. That's where the kwacha has gotten weaker. So dollars are 6.19% more expensive. Oil is 6% more expensive right now than it was last month. So we're expecting the pump price to go up by an extra 2.98 kwacha per 2.98 kwacha per liter by the end of this month. And also that has to do with a lot of the oil outlooks. Now, if you're looking also at wealth insurance asset, Bitcoin was up 3.7%. It did jump back up yesterday, back about 574,000 kwacha per Bitcoin. Ethereum up 0.6%, while gold was down 0.15% in dollars. Looking forward as well, we also did see that in terms of all the assets, year to date, we did see that bonds up 19.1%, in real terms up 9.7% year to date. Stock market is up 24.8%, up 15.3% year to date in real terms. So dollars up 16.4%, up 7% year to date. Gold is up 23.4%, up 14% year to date. And Bitcoin is up 82.1%, up 7.6% year, 72.6%. And also Ethereum is up 54.4% and 45.1% in real terms year to date. Now, this is where they're looking at, but let's also take a look at quarter to date readings. We're also seeing that bond market is up 5.1% during this quarter. Stock market is up 11.1% during this quarter. USD is up 19.8% during this quarter. Gold is up 20.2% during this quarter. Bitcoin has finally edged positive due to yesterday's rally, up 1.7% during this quarter, while Ethereum is down 0.7% still during this quarter. So you can see it's mainly the mainstream assets. So what I always like to say to people is that these cryptocurrency, gold, dollars, these are highly volatile assets. So you want to try and make sure that you're not swinging as much in terms of things that are very volatile, and always try to do something called risk balancing. We'll be talking about that later today. Now, getting into the deep dives for the day. And as we always say, anyone who has any questions, stuff, we're getting into the deep dives for the day. Zambia plans to offset. Zambia plans a carbon offset venture, which will take about 5% of its land mass. Now, Zambia did sign an MOU with two Chinese companies to rehabilitate forest lands of over 4 million hectares, or 9.8 million acres of land with Chinese companies. The pact is with Guangxi Fengling Wood Industry Group and Development Company Limited of China, which will include 100,000 hectares of plantations of slashed pine. Now, this is why they're using the whole carbon sinks business, is because carbon sinks are actually a way to actually attract capital into your country, because you're actually getting paid for retaining your forest. One of the problems we've had with the whole conservation story is that we are often asked as Africans to conserve our land at the expense of economic advancement, while the Western world has slashed and broken down their land in order to pull themselves up. There's a lot of unequalness in a lot of what's always asked of us. The Western world decides that they're going to get rich off carbon. They're going to pull out their people from poverty by utilizing carbon, or at least petrochemicals, or by using carbons, but they are hydrocarbons. But then they turn around on us and then they start saying, no, you people have to be green. So now we have to start taking the harder way out of poverty. They turn around on us and say they go and brutalize all their land to build their urban centers and their industries, and then they turn around to Africa and say, no, preserve your land. You can't go around taking out your land. So there's a lot of demanding Africans do things with little compensation. So it appears at least this could be a mechanism to actually incentivize us to keep our conservation lands, because then it acts as carbon sinks. It acts as a carbon sink for what they are at least doing, for the pollution they're basically emitting all over the place. So this will help. This will probably help, at least even in getting some inflow of capital in. Mozambique is doing it. Madagascar is doing it. Gabon is planning on doing one of the biggest ones right now in the country. There's targets to do with the Congo Basin to make sure that these countries are compensated by the carbon credits industry, to at least drill into that. Now, other news that we also did see, Zambia did sign an MOU with ZTE to ensure to one day create an IC to one day create Sorry, I think we just missed that up. Zambia signs MOU with for assembly plant, ICT MOU assembly plant with ZTE. There are plans to actually now create smartphones in Zambia. This is to ensure that all citizens can afford to use smartphones and be able to access future government services. They're talking about trying to engage in e-commerce, trying to engage in social commerce. Yes, about 30% of our population have smartphones, but you're trying to get to about 80, 90%. That way, commerce becomes easy, money becomes easier to interact between one another, and a lot more changes. Also, this comes off the heels of an MOU that was signed with Huawei Technologies to help improve ICT infrastructure, adopt renewable energy, support innovation, expand access to digital services, and create an ICT talent ecosystem to help with the development of digital skills. Now, this is very important to try and help us because this is about trying to march us into the future. So these are some of the deals that are coming out of the president's trip to China. We'll see whatever else comes out of it. This is relatively important. And the US and EU did jointly support new Africa railway line between Zambia and Angola. This is quite important news because this has to do with the Sonangol plant. A lot of this has to do with trying to get minerals out of and using the Atlantic so that we can possibly trade directly with the Western world. So they're obviously going to now try and start investing in railway operations to try and link DRC, Zambia, going all the way through Angola. Remember, you've got the Sonangol plant, you've got cobalt coming out of DRC, and you've got copper coming out of Zambia. So they're looking at what they can do to make the journey easier for it to also go west and not just only east. Now, this is it's part of the development of the Trans-Africa Corridor connecting Southern Africa, Southern Democratic Republic of Congo, Northwestern Zambia to the regional and global markets via the port of Lobito in Angola. And the Lobito Corridor represents the alternative strategic routes for exports for Zambia and DRC and offers the shortest route to linking the mining regions to the two countries to the sea. So this is a different route that they're offering them. Obviously, this is also the competition for minerals coming from that part of the world. Now, the reason why this is important is also because whatever can go that way, meaning stuff can come back. Remember that there's the Sonangol plant also in Lobito that should be getting completed by 2026. And should it be able to use the same Lobito corridor, then we should be able to get oil coming in. That should actually support that. So this also helps with future oil supply chain investments. That's why I keep saying 2025 onwards, specifically 2026 upwards, you are probably going to see some changes in the oil supply chain going all the way up to 32. These are much more transformational, pronounced changes in the oil supply chain, which will potentially reduce, especially the petrol costs. Because currently, one of the problems petrol is facing is that it's exposed to high diesel prices when trying to bring product in. Simultaneously, yesterday we did see oil jump 2% to a near 10-month high as OPEC predicts tight supplies. Now, remember that right now OPEC is expecting that the global powers, that the non-OPEC nations, are going to be producing oil at only 0.7% year-on-year growth through quarter four, and that's expecting oil prices to pump and then also be weak all the way to 2024. While they're expecting oil demand to rise by 2% quarter four and then another 2% in quarter four next year. Now, OPEC also is basically stuck to its positive oil forecast, mainly due to the fact that Latin America, China, and Africa are all going to now start increasing in their demand, while simultaneously supply will be low. Remember, Saudi Arabia and Russia have pushed prices down because pushed output down because they're trying to keep prices high. So OPEC's monthly report forecasts that demand will be 2.25 million barrels a day in 2024. OPEC will rise by 2.25 million barrels, while supply will only rise by about 0.7 million barrels. So in other words, 700,000 barrels, meaning there'll be a much thinner deficit. There'll be a much more pronounced deficit in supply demand pushing prices up. So this is the expectation that we're going to see prices staying around 90. Other thing that did add, by the way, to the oil price getting to 92 were the floods in Libya, which shut down about 4 of their refineries, or 4 of their oil operations, which actually ended up taking 213,000 barrels of oil off the market for the duration until they restart those operations. So the ongoing global economic growth is forecasted to drive oil demand, and especially driven by the recovery in tourism, air travel, and steady mobility. Remember, everyone is coming back to work. Remember, we're out of a pandemic, so people are in their cars and they're back to moving around and being transported. Air travel, because of tourism, is really picked up. Remember, there's been the IATA data that we've been looking at what's been happening in terms of air travel, where we've been seeing almost a pre-pandemic recovery in international travel, sorry, in domestic travel, while we're almost at pre-pandemic recovery when it comes to international travel. So we are seeing a lot of activity happening that is pushing oil demand, especially driven by the global tourism sector, which is largely driven by Asia, and also a very strong recovery in Europe. Now, other news in the copper markets, we did see that Barrick plans to double its copper production to 440,000 metric tons by 2023. One of the biggest pieces of news that the CEO Mark Bristow did actually mention was that Lumwana Super Pit extension is now targeted to be completed its feasibility study by 2024, which has moved forward its production expectations from 2028. So this is expected to deliver a potential 240,000 metric tons of copper per year on the 50 million ton processing plant, expected lifespan of 36 years of the mine. So this is what you need to start seeing. There are investments happening in the Lumwana Super Pit extension, which is actually pushing for an extra 240,000. So this is obviously adding to the optimistic view that post-2025, we should be seeing the ramp up of copper production, and also expected the prices. So you can see a lot of these mining companies are planning their expansions for the copper price takeoff, which is expected to start on the other side of 2025, when we start experiencing global shortages of copper, which should push prices up somewhere around $11,000, with the expectation of it going even as high as $15,000. Now, Reko Diq mine, also in Pakistan, is positioned to become one of the world's top 10 copper mines when it reaches its full production. So this is what's driving Barrick to believe that they're going to have a high output by 2035. Part of that has to do with Lumwana. The other part has to do with the plans to double their output also. And we'd like to take this moment to just take a breather and welcome Stephanie on the other side. Stephanie, how are you doing this morning?
Hello, Munyumba. How are you?
I'm fine, thanks, and welcome into our deep dives as we're going. Recap. We are touching on some positive news where we are seeing that Lumwana is now planning its expansion. So that's why I've said that in Zambia, what you're going to see is a lot of short-term pain between the period of 2020, between now and 2025. This is going to be a period of pain. Low copper prices, high oil prices, weak currency, while we're still negotiating our private creditors. I don't see this concluding by this year. Probably private creditors will probably sneak into next year. And then that's probably when we'll start to see that cool off. And then also next year, bear in mind, there's the expectation that America is going to slip into a recession next year. So you will be probably seeing a global recession, high oil prices, low copper prices. There is that mix of economic activities that will probably be very hard to get through. And all at the same time, we're dealing with regional demand for our maize, which is driving up the prices. But if we play our cards correct, and this is what I would like us to all think about very carefully, if we play our cards correct as a country, we come out of 2025, 2026 with a stronger mining sector and a much higher price. Structurally, we'll probably start to see the supply chain changes between 2025 and 2030. 2026 and 2030, we start to expect the supply chain changes in the oil market. And then if we deal with the maize market, maize is a very difficult argument to have. On one hand, everyone is talking food security and low cost of food. But on the other hand, food production is how most of this country makes its money. So this is the tricky thing about food in Zambia. The majority of this nation relies on farming for revenue. So they need the prices of produce as high as possible. But simultaneously, the majority of this country relies on milling meal for food. So they need the prices as low as possible. Striking that balance is difficult. Here's what I say. As I say again, it's going to be a lot of short-term pain. If you take a look at a lot of the interventions from the president's speech when he was opening parliament, especially in agriculture, they were talking a lot about supply-side interventions, mechanization loans for small-scale farmers, building out of farm blocks, infrastructure to help develop farm blocks, irrigation investment. They were not talking about trying to bring back subsidies. The reason is they need to incentivize the farmers, especially the commercial farmers. The biggest problem in this country is that subsistence farmers grow at only 33% the efficiency of a commercial farmer when it comes to maize. So, meaning on 1 acre or hectare of land, the commercial farmer grows 3 times more maize than the subsistence farmer, because the commercial farmer has a lot more data. They've got a lot better systems, and they've got a lot more experience in doing a lot of this at a commercial level. So I think, and they've got a lot more capacity. So the journey should be, how many of our subsistence farmers can we convert into commercial farmers so that we can increase the productivity? The key the actually said was productivity, which means production per unit of resource. Okay, so the amount of output per use of land, per use of resource. The reason I keep driving at this, Stephanie, is our reliance on the rain-fed sector on the direct rains for our maize output is a problem. Why am I saying this? At the price that maize currently is, okay, and the fact that you've got million-ton orders coming in from Tanzania, Kenya, DRC, Angola, you've got Malawi, Zimbabwe. Okay, these are all countries trying to push million-ton orders from Zambia because they need your maize. But we are barely produced, so that's about 5 million tons of demand. And if you try and put that correctly, Stephanie, that's about $1.2 to $1.5 billion of potential export, which helps regularize and manage our currency. The same currency, by the way, we're crying about when it's harming us on the oil prices and import costs. So the problem is we have to export our maize in order to be able to do that. But then we also need maize to feed our people, because our people mainly consume maize products. So it's not like copper where we barely use it and we can export the bulk of it. We need to consume it domestically. So the only solution now is, one, you need to keep productivity high, and you need a lot of investment in farming technology and infrastructure. Now, how do you encourage investment? I'm sorry to say this to people, high prices of maize. It's the high price of maize that encourages the farmer, and the growing price and the growing market. Growing market and high prices. So when they know they can access export markets and they can get higher profit margins from it, guess what people do? And everyone does this, Stephanie. Not just me, not just you, not just the farmer. They're not all greedy. Every human being will invest more money where they can see they can get more money. Am I wrong or am I right there? Exactly.
That's true. We
Yeah.
look for the
So
opportunities. Yeah. Yeah.
exactly. No, sorry, continue. Okay. Yeah, sorry, I was saying, you
Okay.
can continue. Yeah. But what I am going to drive at is saying that every human being chases their maximum profit. We do the same thing, by the way. You're going to get a degree in an area, in a field you feel like you're going to get paid the most. You are going to exert your work where you feel you are going to get appreciated the most. The problem is, why are we asking the farm community to do something that we know ourselves we wouldn't be willing to do? So yes, food security is important. I'm not saying it's not. But don't expect the farm community to expect low prices. They want high prices too. The same way you want a higher salary is the same way a farmer wants a higher price of maize. That's the truth. And we all don't want to talk about that. Your higher salary costs more to your employer, the same way the farmer's higher price of maize costs more in milli meal to you. So that's something we all need to look at very carefully. So we're trying to make sure that they have access to markets where they can earn more. We've seen this, by the way, even in the cement industry. When companies like, I think it was Lafarge, was exporting its cement, it's because it was getting a better price in the export markets than what it was getting domestically. When the currency was weak and people were buying cement at higher prices, they were getting it out there. If you look at even Zambia Sugar, they export sugar. So they parry the sugar that they export versus what they can sell for it here. That's why the sugar price per kg has stayed $1 in this country. Okay, we're basically still $1 per kg of sugar. The reason is these people are gauging how much they can sell their sugar outside versus what they can be selling it here domestically. That's why the price of that product is effectively dollarized. So exportable goods end up being dollarized. And that's a reality we have to face. So now if we play our cards correctly and focus as a nation on productivity in the farm sector, then we come out of this. Because here's the problem, Stephanie. Tanzania is asking you for 1 million tons. Kenya is asking you for over 1 million tons. DRC is asking you for so much. Zimbabwe is asking you for. Angola is asking you. Malawi is asking you. So you've got these countries that are all asking you. If you don't supply them, do you know what these countries will do? They'll go and ask someone else. Somebody else will become their supplier. And now when you've sorted out your productivity issue and you have a bumper harvest, you've got no customers to sell to. So there's an export market here that's potentially $1.2 to $1.5 billion worth of maize export that would really help this country by then being able to export over $2 billion worth of agricultural produce to help diversify our exports. But if we kick them out now and start talking only food security, in the long run, we'll lose a customer. In the short run, we'll defend our food needs, but in the long run, we'll lose customers, and we'll be the same people crying, saying, how come there's no economic growth, there's no jobs, there's no economic expansion in this country, things are broken. But it does require long-term thinking in order for us to be able to achieve that. That's one of the reasons we have to be very careful with this conversation. Now, on the other hand, Stephanie, one of the things I also seen yesterday is the China Central Bank is going to scrutinize bulk purchases of dollars. Chinese yuan recently has declined by about 6% so far against the dollar, causing inflationary pressure. This is the worst decline of their currency since the global financial crisis in 2008. Companies that will need to purchase over $50 million will now need approval from the Central Bank of China. So, Stephanie, today I want to talk to you about the word risk. So here's a question I'm going to throw out to everyone, Stephanie, as I ask you now. What is your risk appetite? Do you consider yourself a high risk taker, medium risk taker, or low risk taker? I'm going to ask that to everyone in the audience. What is your risk appetite? But I'm going to ask you first, Stephanie. What is your risk appetite?
High risk. I take a lot of risks, Munyumba.
Elaborate. What do you mean? What is your view on risk, and what do you define risk as?
I think for me, risk is anything that I stand to lose instead of benefiting something. And so when I talk about me being a high risk type of person, it's I don't really put in a lot of thought. I'll just do it. For me, my narrative is do it. Whether it returns or not, just do it. That's me. So we'll see the results later. Let's see. Let's do it now.
Yeah, I'm more of a, and I've actually done a personality test to show this. I'm more of a medium to high risk taker. So I'm a very calculated risk taker. So I do take risk, but I always calculate my risks. I always go through what is the potential downside and how do I protect myself from that downside. Then I get to doing it. So I do. There's a little bit of a hesitation I always take, just to always make sure that I calculate the risk. Jesus always says, "Count the cost." He said that in the book of Luke. He said, "Count the costs before following me." Always calculate your risks and then take them. It doesn't mean run away from risks, but calculate them and then take them. So the topic of discussion today is risk. For investing, what we're going to be discussing is what is risk? So risk is the chance that an outcome of an investment's actual gains will differ from what you expected. So Stephanie, if you plan to make 1,000 kwacha on let's say a day of sales, and today you make only 500, tomorrow you make 5,000, the next day you make 250, another day you make 1.5, then another. That's very confusing. You can't discern a trend there. So that's what we call high risk, when it deviates from what you expect, okay, or what has been the average. So risk includes the possibility of losing some or all of your original investment, not getting what the expectations were. So in other words, if you expect to lend out money and you expect to get a certain interest rate, risk is the probability you don't get paid or don't get paid back on time, usually assessed by considering the historic behavior of an asset. So always go back to the history. How has this asset performed versus what has been the average return, and then how does it deviate from that return? That is called the standard deviation. What is the average deviation or distance between between all the outcomes and the average return on investment, or the average earnings you make from an investment. So we use that as well. So we look at maybe asset prices, we look at growth of asset prices, we look at cash flow generated from an asset. We always look at this, and that is what we basically look at as risk. So you have to ask yourself a question: what risk are you willing to take? Now, each investor, every person has a unique risk profile that determines their willingness to withstand risk. Now, that stands with your personality. I'll tell you, take your Myers-Briggs personality test. That will tell you what kind of risk taker you are. Even your Jungian archetype, if you're looking for personality data, they also are capped into risk-taking groups. There's also your lifestyle. If you also know, there's a test by Dave Ramsey's group called Know Your Money and Know Yourself. It tells you, are you a spender or a saver? Do you think of money in abundance or scarce? Do you think of money for status or security? Those three things will tell you what kind of appetite you have for risk. If you're a spender, you generally are higher risk. If you're an abundance thinker, you generally have more of an appetite for risk. If you're a status person, you more have an appetite for risk. So those are signals that will cue to you. So there are psychological evaluations you can take to assess your personality, to be able to know what kind of risk taker are you. Also, what kind of lifestyle do you live as well? Are you a family person? If you're a family person, you're taking less risk because you have to think about your children. You have to think about your spouse. Depends on what kind of lifestyle you tend to live, what career you take, how old you are. The younger you are, the more risk capacity you have, because you can recover from making mistakes and having errors as well. Your knowledge, all sorts of other factors come into play when an individual makes their risk assessment. But in general, investment risks arise from investors expecting higher returns to compensate for those risks. So the more risk you're willing to take, it's often because there's a higher return you're chasing. So this has a potential of giving you a much bigger outcome. So you want to calculate it, and we're going to call this risk balancing going forward. Now, they are what we call risk-free assets. Now, there's no such thing as no risk, okay? There is no such thing as no risk. But there are some assets that have got such little risk, in other words, the capacity for them to deviate from what they can produce, that they're considered riskless. Okay, and riskless securities form the baseline of how we measure risk. So we use those as a baseline. Now, examples of risk-free assets are fixed deposits at a bank or savings accounts. However, if that bank fails, by the way, your account is gone, your money can be gone. Okay, if that place where you've deposited your money fails, then it's gone. But the probability of a bank failing is very low. Okay, it doesn't mean it can't happen. It's just that the probability is low. So that's why people consider them almost riskless. Government securities, treasury bills, and bonds. Now, investors can lose their money if the government defaults on debt. But if you're looking at the historic trends, the government hasn't defaulted on a coupon payment and debt on local debt, not international. Local currency government bonds, people. Difference. In Zambia, we use the 364-day treasury bill as what we call the baseline for the risk-free lending, the risk-free rate of return. That has a rate of return of 16%. So everything above 16% is considered risky, okay? That is a risk premium that we're adding on top of it. So here are some of the types of risk that a person will face while investing. One is called systematic risk. This has to do with the larger, broader economy failing. And this can be due to political instability, macroeconomic changes, and volatility. And it's hard to mitigate against systematic risk. Okay, the whole economy going into a meltdown, it's hard to mitigate against that. Just like what happened in the pandemic. Almost every asset went down when the pandemic had occurred. Other things that also bring systematic risk, you find it is interest rate, inflation, currencies, liquidity, country risk, and socio-political risk. Unsystematic risk, or specific, or what we call idiosyncratic risk, is risk specific to an investment. Okay, not the broader economy, specific to an investment. For example, political risk, like we've talked about before with Copperbelt Energy, where it faced political risk when it was trying to negotiate its bulk purchasing agreement with ZESCO back in 2020. That was a risk specific to that company. The illicit market for national breweries, where they're trying to compete with people who are making chigayo and that stuff on the side of the road. That is a specific risk to that. It doesn't affect the rest of the economy. It affects that company specifically. So you must look at systematic risks and idiosyncratic risks and which ones are playing the most. Other types of risks you're looking for, and I'm going to go through them so that you get a basic education on risk, is that you get business risks, which is, can the company generate enough revenue sufficient to pay its costs and still have a profit? So this can be mitigated through managing the cost of goods, having higher profit margin, defeating your competition, and increasing the overall demand of the market. That's how it's mitigated. Operational risk, when a company is able to make sufficient sales. So operational risk is also simultaneously whether a company is able to operate its own, whether a company is, sorry, we just had a mistake there. But operational risk is whether a company will face human errors, system failures, and all sorts of other things, and mitigated through internal controls, systems, mechanisms. Legal risk also comes from things like changing laws, regulations, disputes, but that can be mitigated through having compliance programs and systems, monitoring for changes in regulations, and having a legal advisor to also help you through any of these other changes. You have other risks, and I'm going to summarize them. We're going to go through most of them in the following weeks, whether we'll be going through credit default risk, country risk, and foreign exchange risk. We'll be talking about types of risks in terms of interest risks, political risks, liquidity risks. We'll also be talking about risk reward and how to deal with the risk reward and also the risks and diversification strategies. So for now, that was an introduction into investment risk, but it just often speaks to what is the difference between what you expected and what will come out. Next week, we'll go deeper into the types of risks, and then the following week, we'll go into diversification against risk, so that as an investor, you're equipped. You now understand what risk is. I'll tell you what risks to be looking out for, and then we'll be looking at how to now break down diversification strategies against risk. And that has been our conversation today, Stephanie. What's your takeaway on risk that we just talked about?
My takeaway when it comes to risk is that take a risk, but obviously make sure it's a risk. I'm also looking forward to actually get to know, what risks is supposed to be taken, because then what risk is necessary, what risk is worth taking. That's also the question. Is every risk worth taking? That's one thing that we get to actually hear from you again, Munyumba. I don't know if it's tomorrow again when we have this conversation or next week on a day like this one, but I'm looking forward to this conversation.
And I will give you a metric that we can use for what we call risk-adjusted returns. How to measure whether a risk is worth taking by utilizing risk-adjusted returns and also a margin of safety. That is something we'll go through in a couple of weeks now when we'll be talking about strategies to mitigate risk. But with that, Stephanie, I wish you a wonderful day. Thank you for joining me. Thank you for everybody who's been with us, and have a wonderful day.
Thank you very much.